we'd like to now segue into a panel discussion. If I might invite my panelists up up here, please, to the stage. Jan, Jared, David. Why don't you go next to me here? If I can first turn to Jan. Jan, we all heard the presentation. I wanted to just ask you for your first reaction before I go into some questions that I have. What struck you out of what you heard there?
Well, there was interesting, as you mentioned, talk going through all the basic stuff in terms of the world economy and for sub-Saharan Africa as well, and Kenya. I think there's a lot of things that from the IMF's point of view, that really the concerns and the risk that you put forward are really in line with the view that we have been taking, and in terms of the Kenya situation as well, similar concerns and risks. But I would say in terms of the growth, sometimes it helps also to look back a little bit to understand what happened. And we are maybe slightly more optimistic in terms of where growth may end up for last year, because last year in some sense is not gone yet. In a sense,
we would be happily wrong, especially in 2018.
Since we do not have all the data yet from last year, so we do believe that mainly because of agriculture, which is a sort of a sector on its own, and because of the drought, is still in the process of picking up. So the last quarter of last year may still see some pickup in agriculture, and that may contribute to that. The 4.7% growth that for the first 3 months, three quarters of 2017, we have the numbers as 4.7% growth compared to the first 3 quarters of 2016. And if you look at Q4 and agriculture is still picking up a little bit, you could easily get very close to 5% for the year as a whole. So that is a possible income for 17. Yeah,
so
for 17.
Q4 is actually being stronger than the first 3 quarters.
Yes, because of agriculture.
Yes.
Because we already saw agriculture is in the process of picking up in the third quarter, and that is likely to continue. And then you may also see a little bit of pickup effect from sort of the political stability that materialized, and at least part of Q4. So. And that is a base in terms of making your projection also for 18. I would also say another helpful thing in terms of the projections we do looking back is a little bit the experience that we saw in 2017 do also demonstrate the resilience of the Kenyan economy as a relative newcomer to the country.
Yeah, and what does that word mean? Because everybody keeps using it. They've been using it for 10 years. What does it mean? Was Muhammad Ali resilient when he was punched on the ropes for 10 rounds? Is that what you're talking about? What are we talking about when you say resilient?
That's pretty resilient as well, yeah.
Yes.
I wouldn't be able to.
No, but it's a favorite word everyone uses.
That's okay. I mean, that's what I was, going to explain. At least the way I look at it as a relative newcomer to Kenya. Given the very significant shocks that we saw last year, and they were really significant, both on top of the drought, there was a real shock, and in terms of the political shock, that was reported around the world, and in that sense, it was a shock that everybody knew about. All investors, everybody talked about it. Despite of that, we are still seeing an economy that's been growing quite strongly. 4.5% or so. And if you take agriculture out, we still have non-agriculture growth around 5.5% during this period. This is one reflection of resilience. And if you look at exchange rates, relative exchange rate stability, and a stability that's not maintained just by pumping dollars out in the system from the central bank, but it was maintained during a period where reserves were more or less maintained at a stable level. You look at the financial sector, you look at the stock market, still quite stable. So it shows, to me at least, that investors stayed put. Investors in portfolio, in capital markets, investors in real assets, they stayed put in Kenya. They believed that this shock would be short-lived, and therefore they were not fleeing and they were staying around. So that is resilience, and that resilience, in my view, is really coming from this sort of tradition of macro stability and an economic model in Kenya that have traditionally relied on the private sector and also created a very dynamic private sector and has the infrastructure and so on that builds a private sector. So I think that has been very helpful, and that is a base to move on to to the coming years. And I know we'll come back to some of the challenges where I very much agree with Russia and some of the risks that we are facing, and those will materialize not necessarily this year, but in the years thereafter, if they're not addressed now.
Just wanted to ask a couple of questions. When I studied the shilling last year, if you look at the commentary in the paper, you would have thought the shilling is traded as one of the most volatile currencies in the world. It moves 50 cents, and everybody's saying the shilling is down. But when you compare it, Razia, with any other African currency, and I'm including you in this, it looks like one of the least volatile currencies on the entire continent that is freely traded.
Sometimes, curiously, for an economy as liberalized as Kenya, it almost looks as though Kenya has a dollar peg.
Yes. And then just in addition, you were mentioning agriculture, and what's very noticeable is, should we all be meteorologists now, as well as as well as studying economics, because it has such a huge impact on whether it's inflation. If you look at the times that when we've seen significant inflationary surges, it's all been to do with the weather.
Well, I think you should.
Yes.
That's a real sector.
Yeah.
And that's a real shock. Weather shocks are probably here to stay. At least that I'm not a specialist on climate change, but it seems really to be the more normal is that there will be a drought or the opposite in parts of the country, and actually in many parts of the continent. So that is an important element it's going to be part of your projection, and also not only your projection, also your behavior in terms of how you adapt to this new environment. And I think there's a lot of things to do there also, and I think the government also do recognize that and are looking into ways to adapt.
Yeah, and one more question before I move over to Yared. Razia was talking about this interest rate cap complicating monetary policy, saying that even if they cut rates, it's not going to make any difference because it's not going to transmit effectively. What is your feeling around those comments and around the cap and the transmission of monetary policy?
I very much agree with the analysis, and we have been making that point for quite some time, actually, since the caps were put in place. In 2016, we made the points, and this is a policy that in many ways goes against the spirit of the IMF program that the government of Kenya has in place still. In terms of, I think it's important to address it. I think the argument we're trying to make here is in many ways it goes hand in hand with the other issue in terms of fiscal consolidation that would help to reduce the government's demand for both domestic and external debt. That domestic debt demand will make it reducing that demand would make more resources available for the private sector, and then the supply side, in fact, in some sense, is to have the banking sector being able to risk properly and price risk properly, and that's where the caps comes in. So in order to make that transition from resources now being put in to financing government deficits, to being transferred into private sector investments and liquidity support. There's a natural relationship between those two policies to consolidate on the one hand, and on the other hand, make the banks more capable to transform those free resources now into productive use. And in many ways, it's also seems to be an important measure to support the government's priorities in terms of the big four, where two of the big four are manufacturing and agriculture. And obviously you need resources to achieve those goals. So I see it very much goes hand in hand in what the government's priorities are also. And I agree with the importance of addressing both of these issues as soon as possible.
I was trying to, when we were sitting at lunch, I was saying that, I thought the IMF was probably the biggest investor in Kenya in terms of the facilities that you provided, in terms of the backstop. Can you just give us a quick view on how much you have invested in Kenya before I move to Jared?
Well, I mean, actually, the investments we do in Kenya right now is more in terms of technical assistance than advice, because the program we have in place is a precautionary program. It is, it's a $1.5 billion program, but it's precautionary, meaning that the government do not draw on it, and they haven't drawn on it. It's viewed as an extra buffer.
Is it counted in those numbers about our FX reserves?
It's not.
It's not.
It's not, because it's a reserve that's a buffer that's available in case that is needed. But I just want related to that. We do believe that the reserve level of about a bit more than $7 billion for the time at this point, that is a very comfortable level, and that's sufficient to withstand the risks in the near term. So therefore, we don't see any need for necessarily using that buffer, but it gives an extra credibility, and of course, the program the idea with that is also to provide support to the framework and economic policy that the country is putting forward. Related to that, we look forward to continue the relationship with the government of Kenya, and the government have indeed requested that we will continue the relationship, and we would start negotiating a new program when the current one expires in March.
Excellent. No, I think as a Kenyan, we appreciate the support you've given us, and we also appreciate, the fact that Madame Lagarde visited, and I think even went to Mombasa to spend some time with our president on her last visit. And being from Mombasa, I was grateful for that. Jared, if I might turn to you. Jared, if I might turn to you. We had a very interesting lunch on Monday, and we were talking around this question of whether Kenya's public debt was sustainable. And I think I'm going to throw that question as it stands. Is Kenya's public debt sustainable? And would you care to respond to that?
Thank you. Unfortunately, there's no straightforward answer to that question, but I'm going to navigate around motivating an answer to it. I think the question of whether our debt is sustainable or not has received a lot of attention, especially in the recent past. Perhaps the only subject that it takes more attention is the English football premiership. So much so that some people believe that moving from sustainability to unsustainability is like switching over a bulb. But I think a good context is given if you take an historical perspective, if you look at the structure of the debt, and if you look at the nature of the debt that comes in terms of the composition of the debt. Now, about 5 years ago, debt as a proportion of GDP was about 44%, and Russia gave some of those numbers. Right now, we are talking about anything close to 56, 58%. That's quite a big jump over a very short period of time. Now, what's interesting is that debt is split almost equally, external debt and domestic debt. But another interesting dimension that has happened over that period of time is that we're increasingly seeing external debt being commercial. in the sense that 5 years ago it was about 7% of the proportion of total debt. Now we are talking about 25%. So increasingly, our external debt is becoming commercial.
And it's more expensive.
Obviously, that's what it means, being commercial. So if you throw in the commercial angle and the fact that it has increased rapidly, there's one thing that is usually not pointed out. The tenor of that debt has actually come down. And that means, therefore, that the obligations that you're going to meet at any given point in time is much higher than it was before. Come to the domestic front. Of course, obviously, all of it is entirely commercial, except a small proportion that is the overdraft from the central bank. And there's an interesting trend that has also happened over the period. 5 years ago, the bonds, which are considered to be fairly long-term, accounted for 70%, and the treasury bills 20%, and the rest is really the overdraft from the central bank. Move forward 5 years down the road, and that number of bonds has come down to around 6%, and the treasury bills, which are short-term, have gone up to about close to 30%. Now, that tells you that as the debt is increasing, much of the domestic is going towards consumption. Now, is that creating capacity for the economy to be able to rebate the debt? I think the simple answer is that we are moving away from creating that capacity. But to me, I think the story is even more interesting when you start looking at, and Rasi alluded to this, the mechanisms of ensuring that we have the capacity to repay this debt. I think the question is, where is it going, and how is it building itself into the broader growth framework of the economy? Now, if you look at the way the economy has been growing, and it's good you raise the point of agriculture. There's one work or analyst who said that just before we started talking about the Africa Rising narrative, somebody actually mischievously said that a typical African economy grows on account of either good weather or bad statistics. I believe that our statistics are fairly good, so the economy can move up or down depending on how the weather is. And I think some of the forecasting methodologies build the agro-agenda component. But what has been happening in our domestic environment is actually very unique in the sense that if you listen to the monetary policy statements over the last 10 meetings, they tell you that demand-driven inflation is very low. Simply telling you that the households are not spending as much. Now, the second thing is that if you look at the credit story, it simply tells you that many of the businesses are operating at excess capacity because of constraining credit. Now, if you look at the remaining component is really public expenditure. When you're looking at public expenditure being the biggest driver of debt, then it simply tells you that we are running out of capacity to be able to repay our debt, and that's why I think, in my mind, the issue of fiscal consolidation is now even more compelling. So compelling that if it's not taken seriously, if it continues being a wheel that is spinning and not moving, then I think we are really seriously facing the possibility of us moving into a situation that is unsustainable. Unsustainable not in the sense of us actually going the Mozambique route of the tuna bond story, but unsustainable in the sense that it will cause strain into the economy. We'll be expending a lot of resources towards meeting our debt obligations. And unfortunately, when we are approaching that region is when everybody is suffering from a disease that I call the benefit of hindsight. Everybody is clever now about the debt. Moody's is in a bad mood, and everybody else is in a bad mood. And that simply tells you that unless something is done, I think we are edging closer to that point where we can say that we have serious issues with our domestic debt. With our debt situation as an economy.
Both you and Razia are raising concerns, and even you, Jan, but where is the cliff edge that you're talking about? Are we talking about a cliff edge which is 36 months away? Are we talking about one that is 12 months away? Are there things that can move that edge much faster towards us, like a sharp currency move? Just give us a little bit of texture around timing. We're entrepreneurs here, people who want to borrow more money, this could have a serious impact on the way we operate. What do you think? And
My thoughts are that if you look at some of the debt sustainability analysis that the IMF and the World Bank jointly do, and other analytical work around the space of debt sustainability, the one area where there's quite a bit of sensitivity is on currency movements, given the kind of picture that I painted. But you and I know that the central bank hardly allows actually there's somebody, I guess, who is given, whose day job is to make sure the shilling doesn't move. And that...
I think David knows who that person is.
That, to some extent, explains why there's a lot of sensitivity around the currency moving. But there's something that Razia mentioned, which I think was very interesting, the aspect of the real effective exchange rate, which is really the trade-weighted exchange rate that takes into account inflation and therefore measures the economy's competitive.
But no one ever talks about that trade-weighted exchange rate ever, as far as I can see.
We are talking about
I know,
it now.
I'm glad.
Yes.
I'm just saying,
Yes.
everyone will look at that dollar versus the shilling. But you're quite right, sorry.
Yes, but what that tells you that, and this is a debate that I think we can have because there are divergent views regarding whether an appreciation is necessarily good or a depreciation is necessarily bad. I think to me, if you look at it in the context of how it builds into the economy's current account, then you have to start asking yourself a question as to whether any movement in the real effective exchange rate builds into your capacity as an economy to export more. Because the closure in the current account that we've been seeing over time has been more on the side of imports reducing and not necessarily exports being vibrant. And unless you see exports being vibrant, then we continue having a situation where the economy is actually operating at what you can call negative output levels, where our capacity is here and we are growing at this level, and we continue saying that we are resilient, a word that I don't like using. And we also continue saying that we are better than the average of the continent. The reality is that we have to start pushing the economy's rate of growth towards its actual optimal level or its full employment level. But that has to happen if, for instance, your current account is closing on account of you exporting more and therefore having more linkages with the broader economy than you saying that you're closing your current account more by less imports coming through.
Maybe a question for the audience is how many of the audience are exporters and how many might benefit from a weaker exchange rate, just by the show of hands. So who's an exporter? Any exporters in Kenya? We've got one. Fantastic. This says something about export strength in the economy too.
That's
a very small sample.
Wow.
Even the tourism sector is a sort of
Yeah. You want Kaushik, by the way, is a board member of Standard Chartered Bank.
So in terms of export, exchange rate plays a very nominal part. In my view, a lot of exports are dollar-based, so they really don't affect because input-output can be dollar-based. I actually believe there's a conflict and a mismatch between policy and, for example, if you say you want to say manufacturing to grow, if you don't address the issue of markets, domestic market and export market, and for export market is competitiveness. So if you talk of domestic market first, there is so much illicit trade taking place and imports are dumped into Kenya. And really speaking, I think we need a level playing field within Kenya. We have a lot of substandard goods. We have a lot of fiscal indiscipline in collection of taxes, etc. So until that is sorted out, domestic tax is actually not going to go up. And the same thing which Jared said is on exports. If your policies are not geared towards competitiveness, you can't export. If you go and look at the cost elements within our costing, forget international exports, even to Uganda. Uganda, we are ourselves 5 to 6% more expenses before even we start. We have an IDF, import declaration fee, which gives no service, that is 2%. We have a railway development levy, which is 1.5%. We have problems with tax refunds and other things. We have a power problem where the cost of power is very expensive, and you add other costs. In my view, unless they sort out those things, exchange rate doesn't play a role in this. And in addition to that, of course, if you look at the indiscipline on expenditure, on debt, until the country sorts out, then we'll move forward. We're letting opportunity go. I think Kenya has been in a good place for too long, and we have let opportunities go. I think.
I'd just like to add a couple of points to that. Well, first of all, only one person. That was quite interesting, I think. Two? Where was the other? Oh, I apologize. Did you want to say something as well? No? Okay. What I saw in a report, I don't know whether it was the IMF or the World Bank, is that we have a high percentage of our exports actually services, which was quite interesting and different from other economies. But on the basis of what you're saying and the fact that our exports are about 1/3 of our imports, surely we should have a strong shilling. Well, wouldn't it make more sense for us to have a shilling which is much stronger? Right? Jan? Did you agree with that forecast, by the way, of 108 and 108, right?
Well,
107 and 109.
Well, what I agree to is that stability is important, and
Yes.
that is, I mean, yes, the level where it moves could be important, but the stability of the exchange rate, I think, is important for businesses, so they have that risk is ruled out. Of course, so therefore, I mean, with the macro stability we after all still have in Kenya, I mean that, and with the low inflation and so on, I do expect that we will continue to see a stable foreign exchange market. Can I make one point related to the other question you just asked about how close we are to the edge, or whatever you said?
Cliff edge.
The cliff.
Which was what Bill Winters was talking about.
The cliff. Because we are not, in terms of debt, we're not at the edge yet. It's all about risks. But what I think we're trying to say is that the country is sort of within the range of possibilities that a shock, one way or the other, domestic shock or an international shock and so on, can rattle things quite a lot. So that's the concern. So therefore, while we're still in this relatively comfortable situation, that's the time to address it. And for many reasons. Of course, for the debt situation as such, and create credibility and be able to borrow also at better terms when it comes to it. And to do that restructuring of your debt that you talked about, I agree a lot with you that when you do debt, it's not just to finance spending, it's also to restructure your debt and make sure that you can roll over your debt. So that means when you issue a Eurobond, it's not necessarily just to spend all of it, it's also to use it to pay debt off with. So, but anyway, that's one. The other thing is related to the debt situation is, reducing, transferring money from the public sector to the private sector, right? So, and again, that should be a growth-inducing exercise, and that's also going to help on your debt burden going forward. And related to that, and the credit we talked about, I think it's an important point to try to disentangle this a little bit. There's, of course, there are two stages in this. In a sense, the caps and the low credit growth you see to the private sector, part of that today is being challenged to the public sector. So it's all being sort of wasted and just sitting somewhere. It is being transferred through treasury bills and government spending into development spending to a large extent. However, there's another part, and you referred to it, is that the monetary policy has been made more difficult to manage. So it's not so easy right now with the interest rate caps in play to be more relaxing on your monetary policy, to relax monetary policy. So in some sense, what we're looking for is that fiscal consolidation. You combine that with some monetary loosening, and that gives an extra push, not just transferring the money from the lower fiscal deficit that now becomes available for the private sector, but you also allow yourself to be able to lose monetary policy a little bit, reduce interest rates and so on, that can also help in addition to support private sector. Final point, what you just said, Jared, in terms of capacity, there are many companies, if I understand it correctly, that do, because of the liquidity squeeze, are running at low capacity. A change in credit is not just a change of credit availability for the private sector. It's not just for investment and so on, which takes time. It's also to increased capacity, where you can, have more money to buy goods and services and sell them and so on. So do your business. So that part can end up quicker getting into more economic activity. And that's, in some sense, that's why we, at least, a little bit more optimistic, but assuming that things are happening on these two fronts, right? So it depends on the assumptions you do when you do projections.
Yeah.
Of course.
Maybe I can add just
Yes.
two quick comments in this interesting debate that we're having. I think, and you asked a question about whether the 108 is a realistic proposition, and that is something that I probably wanted to raise privately, but I'll as well
On
raise it now.
behalf of Eva's team who helped with the forecasts, 107.
Okay, make it 107, make it 106 if you want. The thing is, if you have oil prices going up, and your nominal exchange rate is depreciating, then you start watching inflation. So if you forecast that you're going to have subdued inflation and therefore room for monetary policy accommodation, there's a problem there in that forecast. So you probably have to start thinking whether that really is visible. But I think the second point I wanted to make is the point that the director here mentioned about why the exchange rate may not be the only thing to look at right now. I think we have to start evaluating really whether the investments in public in infrastructure is enhancing the total productivity of the economy, what you can call total factor productivity, meaning enabling businesses to produce more for a given amount of input than previously. And that has really been a big concern, unless the argument is that some of these investments will have that productivity enhancement coming with a time lag. I think we really have an issue in terms of the extent to which some of the investments we've already seen are supporting the businesses enhance their productivity generally, and therefore enabling them to access markets more competitively than just relying on foreign exchange competitiveness. And I think that speaks to the other aspect of really whether you have favorable terms of trade, whether you have favorable terms of trade in the international market, taking advantage of that depends on what you produce and how competitive you produce it. So there are so many dynamics that we probably need to address for us to really start shifting the balance from closing our current account on the basis of less imports and therefore more exports coming through.
Are you optimistic about our export trajectory over the next 2 or 3 years?
I think it depends on a number of things. It's not as simple as I'm optimistic or I'm not.
No, but I mean, these investments that were made, do you think they're going to make a material difference and be a catalyst for greater export growth out of Kenya and the region in the next 36 months?
To the extent that some of them are infrastructure in nature, I think they should be able to enable exports in a way. But I think there are other factors that need to come into play, not necessarily those alone. So to that extent, you can say that I'm somewhat optimistic.
And just finally on that point, I meet a lot of people, particularly the multinationals, and they are all beating a track up north to Addis Ababa. And they see Addis Ababa as a kind of holy grail of low-cost manufacturing, a la the Chinese model of 30 years ago. And they seem to be able to tolerate a lot more political risk because we've seen what's happened. We've had a state of emergency there for a long period. Every other day you have problems. What is, just to answer that specific question, what are they getting right in comparison to us that's attracting everybody up there?
I think the Ethiopian model is interesting. It's basically a public investment growth-driven model. And to argue that they are probably getting a return, then it means that they are getting a return that much higher than the political risk they are taking. And I think, to me, evaluating a political risk and saying that the return is able to compensate, more than compensate the political risk, is probably stretching it, because look at what everybody was saying about South Sudan. They went in there, they thought that there was opportunity, they thought that they can discount political risks and go in. And I think the aspect of comparing economies on the differential political risk is interesting, because many of the things they are subsidized. Including their major foreign exchange earner, that's the Ethiopian airline, benefits a lot from government subsidy. All the foreign investors benefit from huge tax holidays. Whether we are willing to give tax holidays for people to come in is quite another. So there are a number of things that they're doing differently. I cannot say that they are necessarily better, but I think the model of heavy public investment has led the economy to grow and even surpass the Kenyan economy. Whether that's a good thing or not is debatable, and I don't know the Russia's views.
I think if we're talking Ethiopia and South Sudan, there's a very obvious expert, but maybe 2
Be
seconds.
very quiet.
The Ethiopian model has received a lot of attention, and I think there are economists very close to us who would question whether the kind of total factor productivity growth implied by the GDP numbers is realistic or not. There is a school of economists who say, very interesting that Ethiopia is claiming what it's claiming, but is the growth for real? From the perspective of a private sector economist, what worries me about the Ethiopian model is the missing middle. Where is that consumer class? How rapidly is it likely to emerge? In a lot of other economies, there's something to be said for the consumption. We know that sometimes that leads to imbalances. Kenya had its experience with very heady growth and a very sizable current account deficit, but the consumption boom here was for real, and people felt the growth, and people knew that it was happening. In Ethiopia, they have received a great deal of attention. The problems with foreign exchange liquidity have been there for decades. They're not changing very significantly. So it may be that, something becomes fashionable and receives attention at a certain point in time, but over time, I would see an economy like Kenya as offering much, much more concrete ways of delivering that growth and the return on investment. And the important thing about Kenya is if you make any money as a foreign investor, you can take it out. That counts for a lot.
No, that's a great point. That's a point I tell a lot of people, that for a 50-cent bid offer spread, which is not the case in any other, or practically any other African country that people are going to. David, I want to turn to you. Pull this all together. And, you're sitting there running the trading operation for Standard Chartered. You're the managing principal, financial market sales. At the end of the day, you've got customers. What is actionable? What is your advice from what we've heard today? I meet people who tell me, Ali Khan, there's no way you can hedge. It's just too expensive. Sure. Right? That's always a refrain that I'm hearing. Tell us from where you're sitting, your cockpit position, what you're advising clients, what are you telling them?
Okay, thank you, Ali Khan. I think the first thing I'd like to say is, thank you to our guests Standard Chartered is hosting this. So thank you to Jan, thank you to Jared, and of course to Razia for flying in. I think I'll start with 2 things. The first is you made predictions about Lamin's predictive capabilities. So the story is a similar one that he shared. 1 to 100
is difficult to beat.
So we should actually be involving him more in our trading room. So we'll probably get things more right if he was there. The second is he always talks about never seeing a one-handed economist. So I'm sitting on this panel and I'm glad that I haven't seen one, because he says, the answer is always on the one hand. Yes. It's this, but on the other hand, it's that. I think the final thing is that I've never, and my team has never been asked for a trade-weighted price on the exchange rate. So, when we pick up the phones, no one goes, oh, no, we're not interested in that. Give us a trade-weighted price on dollar shilling. So you're right, that, it all culminates into the nuts and bolts of the economy and where the rubber meets the road. I think a few things. If you take all the factors that have been presented, so you look at what's happening in the US and the impact that would have on our markets, and you think about this from a forward-looking perspective, and you take the story around the local domestic economy and what's at play with the interest rate cap, and the interesting phenomenon that's created in the interest rate market, where we've seen the monetary policy transmission being hampered, where we've seen in a year where we had elections, we had significant drought, that we actually see yields coming off as opposed to rising. I think these are all the challenges that manifest themselves in balance sheets for clients, in operational accounts for clients. When you look at the FX rate, and amidst all that happened last year, we just see a 1% move. Your argument about whether it's a peg or not, I'll leave to the economists to give that answer. But what it does mean is that when you are a client and in the business of risk, because that's what our clients are in, taking calculated risks for return, that you have to start thinking about what tools are available for you to manage the price risk. And this price risk manifests itself in different ways. So whether it's in foreign exchange price risk through the volatility, whether it's going to be in what happens to crude and how that impacts the mainly importing clients that are in this room, or whether the impact of tapering starts to feed in to investment flows and how that feeds into the exchange rate. The question is, what then can we do? And I think whether you look at 2016 or 2017, at least the sense that I've had is there's been a little bit of complacency. When we talk to clients, dollar rates will always be at this level. Nothing much is going to happen. The currency is stable. But I think the key questions are, what if? And I think Razia talked about that. What if these elements start to change? And so what I'd say is, first of all, the immediate opportunities that we can see are that if you are expecting Kenya yields to come off, so if we look at our forecast for a cut in the central bank rate at some point in the course of this year, and then you look at the story on US interest rates, I think the first thing is that from the foreign exchange market, it has been relatively expensive in the past to hedge if you're an importer, and that's the representation of the teams here, that actually the relative cost of hedging will begin to narrow because the interest rate differential between US dollars and Kenya shillings will begin to narrow. So, if you're looking 1 year forward right now, it is relatively expensive because when you look at the 11% for the 1 year versus 1% on dollar, is a 10% premium. But if you look a little bit further down the curve towards the 3-month point at 8%, then it costs you about 60 cents to hedge 3 months forward. So if you do think that we're at the risk of the currency, the dollar shilling pair rising towards 107, then you can get the effect of having an average hedge over the year and maintaining an effective management of that risk at a relatively low price.
So you're saying doing a 3-month rolling position is going to be more cost effective?
Would be more cost effective, exactly, because you pay close to 60 cents instead of paying close to 5 shillings or 6 shillings or 7 shillings. On the other hand, if you're one of
like a true economist.
if you're one of the 2 exporters sitting here, and I know we have many more exporters as a bank, so that's definitely not a representation of our client mix. They've been benefiting for most of last year, and actually 2016, from actually hedging forward. We've had a relatively stable exchange rate, and you get the benefit of the high forward premiums to lock in a higher nominal exchange rate for your forwards. So whether you're looking at horticulture names or floriculture names, agriculture names, exporters, you could be getting 6 shillings, 7 shillings as a premium to the current spot to lock in the forwards. Now, the forward rate isn't an accurate predictor of future spot, but it's worked out over that period for exporters. So what I'm saying is, if you're an exporter, there's an opportunity. If you're an importer, the relative cost of hedging that was there before has significantly come down, and that's from an FX perspective.
So you're saying an exporter can increase yield by a number, hundreds of basis points by doing a bit of that?
Yes. So what I'm saying is, if you're an exporter and you've set your budget for the year at 104 or 103 or 104, we're currently sitting at 102.80 today, at least when I left the office. And if you had budgeted, say, 104, it's possible you could outperform that by going into the market and doing a hedge, purely because the market factors that come into play in the pricing create that ability for you to get a higher nominal return on your exports. When we look at the US interest rates, for a long time we've had clients who've borrowed in dollars, and we've had clients who've hedged before. But there's also been a lot of clients who sat on the sidelines because LIBOR hasn't moved, is unlikely to move, has been sitting at 0.65 for a couple of years, and suddenly it started rising. Now, and that's when everyone then wants to come and hedge. And of course, when the interest rates start rising, the relative cost of hedging increases because the swap rates also move in tandem. But the good news is actually that if you look at the difference between where 6-month LIBOR would fix currently, so 1.93, versus where the 5-year or the 10-year swap is, these are historically low differences in rates, which we would call negative carry. So your initial negative carry is at an all-time low. So you're looking at the 5-year, somewhere close to 65 basis points difference between where you're currently paying on your debt liabilities on a floating rate basis against 6-month LIBOR versus where you could take a view and hedge that risk out for 5 years and for 10 years. For 10 years, you're close to 1%, 100 basis points. So if you take the factors that Razia put into play and you overlay that against your current exposures, then these are the forward risks that you can actually do something about. And our team is very well placed to pick up on these discussions.
Excellent. So what is your trade of the year then?
Well, these are state secrets. I can't reveal them on TV. But what I would say is maybe another component is our wealth proposition. So we've got a great offering in our wealth offering, great proposition in our wealth offering. And when the interest rate cap came in, we saw a lot of push towards the minimum 7%. People want to move into savings, and we were a beneficiary of a lot of liquidity at the bank. But one of the things we started telling our clients is that you don't necessarily need to focus on the 7% savings rate. That's great, that's a good return. But through our wealth offering, you could come in and purchase longer dated bonds. And one of the concerns that our clients had was that actually, but I need to have this as part of my liquidity. I want to be able to come out of this, and that's the reason I don't go further. But we have the largest secondary market trading book in the country. And what that allows us to do is provide access to clients who want to come out of positions that they may have put on. So essentially, Ali Khan, you can come and buy the 15-year bond that was issued yesterday at 12.5% coupon.
Yes.
There's no tax on that bond. If you gross that up, you're getting close to 15%. And you can put that, and people think, well, that's a 15-year bond. I don't want to have this investment for 15 years. And you'd pick up significant carry over the minimum deposit rate that you'd get at 7%. And we can do two things. When you need the liquidity, we can lend you against the bond that you've invested through us.
What ratio?
Our wealth head is here, so I won't quote the actual rate.
Sorry to get technical.
But I can assure you it'll be lower than the actual coupon that you're receiving on the investment. So it would make sense. And the second thing is if you ever needed to sell that bond to get the liquidity, we could provide you access to get out. So what we have seen is a significant increase from our priority clients, our retail clients, coming into this space and wanting to take on, to get additional yield by going further down the curve, but still maintaining the ability to have access to liquidity at any time that they need it. So that's a good trade, and I think we should sign you up.
Yep, you got me signed up. I'm aware that we've got one more part of the program, which is going to be where we've got 4 booths, and you can interact on a one-to-one with any of our panelists here. But I'd just like to give everyone an opportunity to make some closing remarks. And also, before you make those remarks, thank you all for what I thought was a very interesting discussion that we just had. Jan.
Yes.
Yes.
Closing remarks.
Yes. Well, first of all, what's your mortgage rate in Denmark?
I don't know. But it's much low. It's low.
It's negative, I read somewhere.
No, it's not.
It's not negative? Okay.
But it's low.
Yeah.
It's low. No, I think that Kenya is really has a lot of opportunities in it. I see the outlook going down the road a little bit, being exceptionally bright. There's a lot of potentials. You have the mechanics in the country. There's the infrastructure. There's the IT that's already there. You have a dynamic sector, private sector, and you also have, in my view, a government that fundamentally do value macro stability as something that is important, and they see the private sector as a key to contribute to sort of economic growth going forward. So I think there's a lot of things to hold on to there, and I see potential, and potential down the road. I really see on trade. And I think with the country being able to open up some of the trade barriers, Kenya, Nairobi seem to me to be the obvious investment point for new investors coming into the region that do both want to supply to the market. There's an increasing market and increasing middle class that has purchasing power in Kenya, but also in the region. So with trade barriers coming down, that I see that's potentially is a growth engine going forward. While you may have to move a little bit out of the IT in terms of the growth engine. So I'm optimistic, and I do see a lot of potential.
Great. Razia, I know you spoke for an hour and you gave us so many thoughts.
So what else is there left to say?
Yes,
Maybe
yes.
just a quick summing up, and that is, yes, if you look at researchers' forecast for the economy, it's a little bit less than the consensus. We accept this, and we would love to be wrong. So I hope later in the year, when I'm back in Nairobi, there's a chance to revise that up because we were so wrong on the optimistic outlook. What Standard Chartered is doing, we are investing in Kenya and across all of our key African markets, investing in a new business climate survey, business sentiment survey. This is very different to the PMIs and what you've seen before because it's much more forward-looking. It's asking businesses, polling businesses like yourselves about the outlook a year ahead. There isn't anyone who does this yet, and it's exciting because we think there is that gap. Who knows, maybe it will improve the economists' forecasting ability.
Thank you. Jared.
Yeah, I think to me, there are a number of things that really are working for the Kenyan economy. Not least the fact that we are a very diversified economy and therefore we're not very vulnerable to up and down movements that we've seen a number of African countries experience. Now, how we can sustain that and take advantage of that diversification is to navigate some of the risks that have been identified. One of which, of course, is importing a lot from the East, but relying on the West and the African market for our exports, navigating that territory. Attracting quality foreign direct investment, very critical, because it's not just any foreign direct investment that is used for an economy. Those that are seeking resources are usually interesting, but they are not as good as those that are adding value to the economy. And then obviously being aware that the global financial dynamics, much as we say that we are far removed, actually have a potential of affecting the economy. And those are some of the things that we have to navigate, particularly now that we are seeing normalization of policy. And therefore that interest rate differential coming down and the balance sheets shrinking, coming down the road. How that will affect the local financial system is something that we have to really look at. But I think, generally speaking, we're in a good space if we can be able to navigate more carefully.
Great. I know we're doing that cash and carry trade, but
So yeah, my summary would be that if you think the outlook is positive, there's something we can do to help you enhance it. If you think the outlook is negative, there's something we can do to help you manage the risk.
By the way you eat.
Thank you.
Fantastic. I'd like to thank the panelists. Really was a very engaging conversation. Of course, we were following from the headline act of the session, which was Razia, and it was a headline act, and we're deeply grateful for that. I'd like to thank Jan. I'd like to thank Razia. I'd like to thank Jared, David. I'd also like to thank Lamine and his team for putting together such an interesting and engaging program, and suggest to all of you, we've got something to think about. We've got something to think about how we're going to do it with the bank. Thank you very much.